show you in just a second. So this feature is one that we didn't address much at NASTA, just simply due to the time constraints that we had. But it's one I don't want to be overlooked in this software that you guys can use. What we tried to do, and this was actually the brains of the operation, really where we started, was we wanted to make an automated proposal system. We wanted a system that was immune to administrative errors and was something that you could put in front of a client and it would actually grab their attention. So let me go ahead here. Yeah, perfect. So you guys can see this here. Let me go ahead and pull up a specific example for you guys so you can see what we're looking for. So if I bring this back over to you guys so you can see it, what you'll see here is very basic inputs that you would have in a QIB software. You can name it, you'll bring up your firm's information, your claimant name, you can add IRR to show as well, and all of your basic information here. Your benefits area, this is just where you're going to put in your general benefits, any type that you want. It's very, very simple to go through here and put in any piece of information that you would like: start dates, durations, premium amounts, guaranteed benefits, etc. And those are all basic numbers there. And what's really great is it actually gives you some graphs to go off of. So it's not just numbers on a page, but we can actually represent more information. So again, this entire template is completely customizable to your own firms, your own information. Down here, again, very, very simple setup. This color is what you can change easily, and all of the information here gets automatically formulated. And then down here, we have our graphs, cumulative over the length and the benefits on an annual basis. So this is where you can come in and create a proposal in 30 seconds and have a very, very simple time doing it. So this is where we really started, but is not the main feature of Settlement Analyzer and what we're here for today. Instead, it's actually this page here. So what I want to go through now is trying to show you guys a couple examples. We're going to do 3 today. If you have questions at any time, again, please unmute yourself and ask the question or put it in the chat feature, and I will try to answer it as they come through. So Settlement Analyzer, our basic goal of using this tool is to compare the value that a structured settlement has, the amount of money that it is guaranteeing to pay out to people, versus the apples to apples piece if that same investment amount of money was put into a traditional portfolio. And that portfolio can be customized in a million ways. So what I'm going to do again is just run through one example with you and show you the outputs that come along with it. So when you come to this page, which is the Call to Settlement Analyzer page, you have your first box up here. So you'll select yourself, and then you'll select the claimant that you want to have show up on the report. For this example, we're going to use a 12-year-old and just show you the output of a 12-year-old and show what an annuity could buy. Down here is where we put a lot of our inputs, and these inputs are based off of what we would assume a model portfolio might be set up like. So in this first scenario, and again, these are numbers that are made up but are realistic. So in this scenario, we're going to say that this 12-year-old is going to live another 60 years at a minimum. So that's what we're looking at, is we're comparing a structure over 60 years versus an investment portfolio over these 60 years. Because we'll consider this a qualified settlement, it is not going to be taxable as a non-qualified settlement would be. We'll get to that example later. In this example, let's use $1.5 million, and I'm going to say that this individual resides in Pennsylvania. So down here at the bottom is where we can really customize this model portfolio that we're comparing it to. In this example, we're going to do a very standard Warren Buffett type of portfolio where we're going to do 40% bonds and 60% stocks. You'll see that there is no stock box here. It automatically calculates it based off of the percentage of bonds. So when we put in 40% of bonds, it will be 60% stock. Over to the right is the bond rate. Is there a question? No. So the bond rate is a rate that you can choose based off of current conditions. Right now, the 10-year Treasury is hovering around 3%, but it is fluctuating every day. The example I'm going to do for you guys right now, I'm actually going to put in 4%. We're making an assumption that bond rates in this case may go up and continue to rise. Right now, this is what I would consider to be a generous bond rate given current bond rates, but we are projecting this over, again, 60 years. The number of runs is where the Monte Carlo analysis comes into play. So we will run this scenario 100 times. And out of 100 times, it'll feed back individually, either there was money left in the investment portfolio after 60 years, or there was not money left in this investment portfolio after 60 years. The fees column here refer to the money management fees that happen when you get a financial advisor involved. They're going to take a percent for managing those assets, throughout the duration. So for this scenario, we're going to say they're going to take a 1% fee every year from the balance of the account. This box here, the filing status, is filing status based off of the individual. In this case, is a 12-year-old. There's a lot of different options for you to choose from. The first two are federal rates, just the federal income tax brackets. The second two are long-term capital gains alone. And the last one that we call hybrid are actually a combination of both federal and long-term capital gain rates. When you're looking at investment portfolios, a lot of the taxes you'll pay are part long-term capital gains and part federal income. So right now we have that as a 50-50 ratio. So for this scenario, we're going to say that it will be taxed at a hybrid level, and she's going to be single for right now. Coming to the second orange box here, we have two tabs here, draws and our additional income tab. In this scenario, we're going to look strictly at draws. So the draw in this case is what our annuity is guaranteed to pay year after year for the life of this person. So earlier today, I went on a company software. I put in $1.5 million for a 12-year-old with no rated age, and it was a life in 40. And what I found out was, with those parameters, a structure would pay out just over $61,000 a year, guaranteed for 40 years, again, plus life thereafter. You have your COLA. Should you add a COLA to an annuity, you can add one. For this one, it was straight. And then we have our start year and our end year. And again, this is going to run for the whole duration of the 60 years. So now you'll see, once we've inputted all this information, we have a blue bar that pops up down here called Start, Analyze, or Run. We put in all of our parameters, we put in our draw, and now we have an opportunity actually to see what's going to pop up out of the Settlement, Analyze, or Run. So once you hit that, you'll see that there's information that gets loaded down below here. And for those of you that saw this at NASTA, some of this might actually look familiar to you. There's three main boxes that pop up here. The blue one of conditions is very straightforward. It's simply putting all of the information that you already inputted and it shows you down below. The green and red, pretty self-explanatory. Green is good and red is bad. So what we're looking at in the passing runs column, which is this green box here, out of 100 runs, 21 of them passed or succeeded. The definition for passing is that that investment portfolio after the 60-year duration still had funds remaining within it. The definition for a failing run is just the opposite. Some point within that 60 years, that investment account went to pay out that $60,000 draw and was not able to do so because it had run out of money. Scrolling down just below, you'll see two more things. One, a bar graph, again, just more visual representation for the claimants and the plaintiff attorneys to see. But this right here is the most important, impactful piece, is the graphing. So the yellow graph is the worst case scenario. This is likely where they had negative returns right off of the bat of the account, and it wasn't able to recover. The green chart that you see there is our average run or our median run. That is half the time what is expected to happen. And our blue run is our best case scenario. And you can see if you look over here and you can actually interact with the different pieces, you'll see that it still had over $700,000 left into the account at the end of the 60 years, which is fantastic. But that again is 1 out of 100 times. Scrolling down a little bit further, we get into the real data behind all of the analysis. And this is really where you guys can put your feet into the ground and say that we're not any longer just saying that a structure is better, but we can actually go ahead and prove it. So down here, you'll see on an individual basis, the runs that were calculated, all 100 runs. When you come into this yellow part up here, you can click view. And what you'll actually be brought up is all of the data if you really are interested in a particular run. You can go through all of the data, all of the taxes, the fees, the draws, the balances from the first year all the way to the last year. And you can run all of that information through. And what I want to draw your attention to are a couple factors. This column here, this last year balance, again, at the end of the 60-year duration, what we're looking at is the amount of money that was in that account after those 60 years. So in some scenarios, there are substantial funds still left in this account. As we come down and we see some of the failing runs, we actually see a negative balance. And that negative balance, as you go down, you'll see it actually increases. What this negative balance is showing is the amount of money that they missed out on because a structured settlement wasn't in place. So these are the amount of payments that they did not receive over many, many years. So this one ran out in 2051. So there's a substantial amount of guaranteed payments, that almost $62,000 number that they did not get on an annual basis. If you choose to, you can export a simple run to an Excel sheet if you wanted to keep any of that data. Also note that this calculates the total amount of taxes that people have paid over that 60-year duration. So if we go in here, we'll see all of our information, and it's the sum of this tax column. You'll see some years there is no tax being paid because there was a loss in the account, and some years there's a substantial amount of taxes being paid. And that's the same amount or same idea as this fee column up here. So you'll notice even in years where there's a loss, that financial advisor is still taking out that much money every single year. They're taking out 1% of the account balance every single year. So that's the real brains of the operation. And I know that this is a lot of information to intake at once. So I'm going to keep going through more examples. Before I get there, I want to show you the best part of the platform, and that's really the PDF printout that you can take after you've done this analysis and hand to your client, hand to the plaintiff attorney, hand to the claimant directly, and try to show with data and with an analysis that the financial advisor that they may be talking to, if they're not interested in a structure, this is a very, very neutral, independent, unbiased way of presenting two options to these individuals. So to show you guys, this is the first page. It simply says who it's for. It'll have your logo up here and your name down here. This second page is just a really, really, really brief outline of the analysis that was run, so that this piece of paper gets into their hands and you're not there to explain it. They can at least understand the process that was went through to get the outputs. The third page here is, again, a short summary of the parameters that you put into place to begin with, and then the outcomes that came along with it, including an average final balance of the times that the account had money left in it, as well as the average year that the account ran out, if it ran out. And what I really want you guys to pay attention to is that over 60 years, 2081 was supposed to be that 60th year. So when we're looking at this scenario, we're saying that the average year on which the account didn't have money in it was 12 years short of that full 60-year term. So that's on average 12 years of payments that this individual was not going to receive. Down here, you'll see again your annuity amount that's coming out every year. A couple graphs, and then the last page here is a brief summary again of all of the data, sorted from the most amount of money all the way down to the worst run down at the bottom here. So this is the full entire platform, and this was just one example. So putting this in place, we see, very, very clearly in this particular scenario, there's only a 20% chance that a market portfolio, given the parameters that we've put in place, would outperform a structure that could be guaranteed for this individual for, their entire lifetime, and in this case, guaranteed for 40 years as well. So this is our first example. I'm going to move on to another example that might be a little different, that you would not have initially thought of.
Hey, Aaron.
So go ahead.
Excuse me. Can you demonstrate quickly what would happen in this same scenario, assuming you're live, if the fee was, say, 1.5%?
I certainly can. So Dave brings up a good point. You can change the inputs and the conditions at any time. If they come back and say, well, our fee is less or higher, or bond rates are wrong, we can come in and make changes. So as Dave suggested in this scenario, we can go ahead and change our management fees to 1.5% and run it again. And now we're seeing a little bit of a different scenario here. And who would have thought that a 0.5% would make such a substantial change? But once we go into these accounts, we really understand why. We're taking out an additional roughly $10,000 a year out of this account. In this scenario, we're averaging maybe $25,000 to $30,000 in the first few years in the best case scenario. In this prior one, which you can switch right back and forth to, we're averaging about $15,000 to $20,000 in fees. So we see by adding 0.5% in fees, this account's actually requiring to be pulled out another $10,000 on average in the first few years just by changing the fee by 0.5%. So we see that impact substantially. And for those of you that join us at NASTA, we see the very similar thing if we change this back to 1% and change the states to another one. For instance, if we changed it to Florida, we see that success is actually better because Florida doesn't have state income tax. So we see in this scenario many factors at play that are oftentimes overlooked at time of settlement when people are just looking to where to invest their funds. A structured settlement is immune to these factors. They're immune to where somebody lives, the management fees, the bond rates, etc. So they're immune to these changing circumstances, whereas the market portfolio is simply not. So what's great about this, and I appreciate Dave for bringing that up, is you can change things extremely quickly once you have them set up in here to be able to change your scenario and make it customized for that individual's current scenario. I'm going to move to a second piece here. And I'm going to show you how easy it is to change gears entirely to another scenario. What I want to look at here, we'll say it's the same 12-year-old, but in this case, they don't have a long-term injury, but we want to set up a college fund for this individual. So what we can do is very, very simple. We'll delete over here to our right, traditional trash button, the draw out. It's going to, again, start now, but the college fund won't pay out for a few years. So it's going to pay out starting in about 7 years, and starting in 6 years, and then we're going to pay it out for 5 years thereafter. And then we're going to start with a balance of $100,000. And I just said randomly earlier today, this person's going to be in New Jersey. In this scenario, we'll keep our bond percentage and our bond rate the same for sake of argument. In this case, we'll also keep our fee percentage the same. This individual is going to be taxed at a hybrid single rate. And then again, looked earlier today, and I said, what can I buy with $100,000 for a 5-year period certain? And the answer was this, $26,260.50. I want to pull your attention to the start year over here. This is the draw that we're looking at is not going to start immediately. It's only going to start when those college payments occur, which is going to be in 2028. So once we set that in, we can hit our draw button, and you'll see right there, it simply comes down and shows you where the information or where the draw is going to be pulled from. Once again, very, very simple. You just hit your Start Analyzer button, and you'll see that the fourth run here appears. We'll scroll down. We have all of our conditions at play here. And now we have an interesting scenario where we're looking at a college fund at a more 60-40 scenario. In this case, this is something that you can present, and this is up to the claimant to decide, is the risk worth it in this scenario? Yes, the majority of the times, this $100,000 that you can invest in a model portfolio may outperform the structure, but is it worth the risk? And again, the same information is present here, graphs and all of the data that you could need. So in the best case scenarios that we've put forth, the last balance was only $100,000 left in it. And in the worst case scenarios, they've missed out on $50,000 worth of payments. So this is a scenario that many people may not think to use this software for, but it's perfectly designed to be able to use it. I'm going to take one step back here real quick because I had a question come through me, and I want to show that scenario. So if we're just going to take one step back to the scenario that we just ran, easily change all of the parameters. You can tab over and change all of these easily. We'll go back to the draw, which was 61,692, and we'll hit our draw button to have it enter. And the request was to change the bond percentage. We'll change them from 0 to 40% and see how that changes the likelihood of success. So a 0% bond, which means 100% stock, we're at a 14% success rate. At 10% bonds, 90% stock, 17% success rate. At 20%, we're at 20, 30%, 26, and 40% back down to 20. So there is a sweet spot sometimes with these as well. So thank you for the question there. So it's very, as you can see, extremely easy to change those parameters as they come through to predict that information. The last scenario that I want to show you here was a very asked about question when people signed up for this session was the use of it in a non-qualified space. So I'm going to show you how we do that now. I'll go down here. I made an example. We have a 60-year-old attorney, let's just say. This works for any type of non-qualified case, but in this case, we'll use an attorney fee example, as many of us are aware of that. What we're looking at in this case is a 10-year period certain for an attorney. We'll start, again, the start year is going to be the year in which the money would be deposited. Our number of years is going to be 10 because we're going to buy a 10-year period certain. This button is one that we have not hit yet. It's a taxable button. This is what makes it a non-qualified settlement, and I will show you how that calculates information right below. In this example, I used $500,000, and I said that this individual lived in Texas. If I can find my T's, there we go. In this scenario, I said, perhaps the attorney is a little more advantageous and wants 70% in the stocks and only 30% in the bonds. And then our bond rate, again, I will keep at 4%. And then again, fees, I'm going to keep at 1%. Fees, for the most part, usually range between 1 and 1.5% based off of the amount of money in the account and the duration of the investment account. We'll go ahead and delete our old draw. And I looked at the software or a quoting software earlier today and said, again, what can I get for $500,000? And the answer was this, $56,004 over the next 10 years on a non-qualified case. The last thing I'll change is actually their tax status. I'm going to assume that the attorney is married. Once we change all of that, we have our settlement analyzer bar pop up. We click it, we see that the run pops up immediately for us. So here's our scenario for a non-qualified settlement. And the difference between the analysis that we've done before on quote unquote qualified settlements is this start balance amount. So we're making an assumption and an accurate one where right now the attorney has to pay taxes on that $500,000 and then can invest it. They cannot invest it in a deferred way as we could through a non-qualified attorney fee. So they have to take the tax hit and then invest it with their net amount of money from that $500,000 attorney fee. So all of the same parameters here, the same information. And again, we see nearly a 50-50 piece or success rate to failure rate. And this is another scenario, all of our graphs here, where we could take this, print out our PDFs, present it to the attorney and say, here's our situation. You have a 50-50 chance of doing better in investment portfolio, and you have an equal chance, doing it with the structure. Actually, in this scenario, just a little bit better chance of doing it with the structure. Is it worth the risk to invest it over time? Or is it better to take the guaranteed value of the structure? There was a question in the chat about changing management fees. Yes, you can change fees. We don't have it in a way now where you can change it over time, which is a good question. But we will be able to add that functionality in relatively soon. We're opening this up to everybody in order to gain support so that we can continue to grow and to continue to advance the software. So that is one piece of information. If management fees, let's say in a long-term case, were X amount, 1.5% for 5 million to 1 million, and then once the balance went lower, the management fee may actually change. So we can make it vary depending on the balance of the account as well. But again, that's a new feature that we want to be able to add, and we need people's support in order to be able to do that. So that is a quick overview of 3 scenarios. And again, I know in 40 minutes, that's a lot of information to take in, and a very different way of looking at settlements and looking at investment accounts than I personally ever had before we created this. So I really would love anybody's feedback, questions. I will continue to look at the chat to see if people have questions in general, or feel free to unmute yourself, ask any questions you have, and we can go do any example you want. If anybody on the call currently has a case going on perhaps, or wants to make one up off of the spot just to see what would happen, I'm happy to put it in the analyzer here and print out a result just to give you an idea of how this is possible to be done live, and that there's no manipulation, if you will, on the 3 examples that I created this morning.
Hey, Aaron. Looks like someone's asked a question about tax implications on the investment portfolio. The quick answer to that is the algorithm built into the system understands the tax rates, both federal, state, and local, and depending on the type of investment and the type of profit gained, will effectively tax those on an individual basis, again, depending upon the state and the actual type of gain that's made. It's, as you can imagine, quite complicated, but we've come to the understanding that not everything, of course, is general income or interest versus capital gains and some other things, including the order in which things get taxed and what parts are actually taxable and which are not. So it's like Prego, it's in there.
Looking at more questions here.
Aaron, I got a suggestion for you. Um,
Please, John.
Yeah, so Monte Carlo analysis is based on very rigorous science. I mean, there's tons of information on the internet about that. I would beef up the explanation where you said it's based on a Monte Carlo. I don't know, I forgot exactly the words that you used, but it was just basically, it seemed like one line. I would try to beef that up with a more, substantial explanation of what Monte Carlo analysis is. In
Sure.
a way that people, then everybody can understand, but it is something that scientists use. I mean, it is an important and a really important concept. And
No,
if you hand that
you.
to an attorney, they may not be familiar with it, nor the average person might not be familiar with it unless they've done statistics and regression analysis, or something like that. So just something in there that maybe like a quote from a from some type of scientific journal or something. I could probably find something for you to put in there, but I think it would be a good idea.
Very good feedback. I very much appreciate that, John. A few more questions in here that I want to get to. One of them very important. Are the annual returns of the stocks generated on a completely random basis, and how is the range determined? Two great questions. The first, I'll actually answer the second one first. So we use the S&P 500 index back to 2000. So from 2000 to 2001, and we will add every year thereafter to keep an accurate range. And it is generated on a completely random basis. So right now it's 21 factorial, which is many, many, many trillions of possibilities of the order which they can come through. And the S&P 500 index that we're using includes reinvested dividends. So anywhere from 1% to 3% higher than the standard S&P 500 index you might just see online. Can you do monthly draws? Currently, no. Currently, we are only doing annual draws. It makes the analysis a lot cleaner to do an annual draw. However, if you come into a scenario where you absolutely need to have a monthly draw, it is actually possible to do that process. It involves changing the draws in the years over to the right, but we can currently only do annual. But again, with everybody's support, we might be able to add that feature. Can you do joint and survivor? Currently, no. You can quote within the software to change and predict when that might occur. But right now, there's no functionality for us to do that immediately within the software. The most important question that I think people are asking right now is actually, what is the cost of the software? And it's a very good question, and it's important. So right now, the software, if you go to this website, which is setanalyzer.com, I'll actually put it in the chat here, setanalyzer.com, you'll be able to go in and log in. Right now, Settlement Analyzer is being sold for $69 a month. So it's just over $800 a year. To put that in perspective for everybody, that's the sale of one $21,000 annuity. So that was our thought process when we created the pricing, is that if you get only even one case to settle because of the use of Settlement Analyzer that may not have before, you're already benefiting tremendously. So $69 a year, or sorry, $69 a month. However, and I'll put this in the chat as well, if you use the promo code NEW, which is in the chat right now, you'll be able to use it for a month free right off of the start. So you'll be able to go ahead and ask or go ahead and log in, put in NEW as the promo code, and you'll use the software for a month free, see if you like it, see if you have suggestions to change, see if it helps you out. So go ahead, go on a Settlement Analyzer, you can create your own profile, you can put in the promo code NEW, you'll get a month free to do all of the analysis that we've done here and see if it's something that you guys want to use. But right now, $69 a month is the price. Laura, I know you're here. You have a question and you want to turn your mic on.
I do. Thanks, Aaron. So we're here in Canada, and in Canada, our advisor fees, so mutual fund fees, are tax deductible. So are advisor fees tax deductible in the U.S.? Does it vary from state to state?
So they aren't. I'm going to let Dave, if Dave is still here, to answer that one.
Okay.
Dave,
Yeah,
you
hi,
still
Laura.
Hi.
Hi. As a result of the 2017, whatever we called the Tax Reform Act in the United States this time around, all fees paid for advisory services are no longer tax deductible.
Okay.
So a lot of people don't realize that, but no, those get those are not subtracted as a net factor when
Okay.
considering tax.
So your program doesn't have to account then for that. So
It already does.
okay, perfect. Second question, do you have data on the average advisor fees? I know in Canada, the average mutual fund investor pays 1.93% plus our beautiful 13% HST. So it comes in on average at over 2%.
Yeah,
all told.
that's a good question. You know, here in the US, there are some mutual funds that are open funds, and they have as high as a 5% upfront commission charge.
Right.
You don't know that unless you can get a Morningstar report on what the individual assets are. But generally speaking, across the investment advisory, a 1 to 1.5% is a pretty good range. I think somebody else, you know, asked for a potential reduction on a larger amount. It's not unusual to see an advisory rate dip below 1% above, say, $1 million, or if somebody's coming in with $20 million, maybe that flat fee goes down to 75 basis points. But the overwhelming majority is made up of two things. One is we have the advisory fee itself, and we're being conservative and normally using about 1% so that nobody thinks that we're trying to pin it on the trust advisor. But the other thing is that there's an expense load on any type of asset that is purchased, has an expense to it. It doesn't go to the advisory firm or whatever, but it's the manufacturer's cost. And those expense loads can in some instances be as high as 150 basis points. They typically should be below 50 basis points, but that's a good average. So we're looking at 1% in a fee and 0.5% in expenses. And that's quite honestly, on an overall basis, probably a little bit on the low side. So you looking at a 2 isn't horribly unusual either.
Okay. Right. So we've got those average advisor fees plus, again, additional expense fees. So when we're speaking with clients about that, we point out that even if we use an average of the 2 with tax, you know, there are other additional investment fees as well. But thank you.
And your tax structure is quite a bit more regressive than ours.
Yeah,
Sorry.
I can talk about Canadian taxes all day, but we won't do that.
All right.
Thank you so much.
Do we have any other questions? I'm going to look. All right. So will future versions have the ability to allocate different indexes? That is our hope. So we want to have the ability. Right now, if I go to this side that says Gain Selector, you'll notice that it says S&P 500 Index plus dividends. So our goal is to be able to fill this section up here with more options: 100% S&P, 100% Dow, 100% NASDAQ, some blend of all of them. So yes, it will be a feature that we would like to add in the future, so that people can select the index that they want the account to grow by. See if there's more here. I don't see any more. So I'm happy to answer any other questions that come on through the chat, or people that want to send messages or talk out loud. I am trying to respond to everybody that sent a chat to me. So please stay on if you have. I am in the midst of writing back to you. But I will stay online for a bit, so everybody knows. Again, Settlement Analyzer, $69 a month. If you use the promo code NEW, you'll get your first month free. And then we can go from there. We are going to do another one of these trainings on, I believe, I'm going to confirm this before I say it, on May 23rd, which is a Monday. We're going to go over this same information again for those that weren't able to be present, and then dive into some more detail for those that want to come back and learn more. I am available at all of your guys' convenience. If you have specific questions, want to go through specific examples, want to know how to run a very specific scenario, please let me know. I'm happy to walk through all of that with you guys. So if there are any questions, again, let me know, and I can answer those to the best of my ability, and I will stay on until 2 o'clock or after if there's more questions, if people want to chat, talk, give suggestions like John did. So I will stay here. I'll be quiet for a bit, and I appreciate again all of you guys being able to join and supporting Settlement Analyzer.
One other thing, Aaron, I'd like to add quickly, and thank you for doing this, and thank you for piloting it and being the shepherd of it for all this time. Like any piece of software, this is really 1.0, and by the time John Dare is done with it, it'll be 8.0 when we get down the line. But realistically, we have the understanding that our production numbers are down 35%. And we always know there's a place for cash, but we also know that in a lot of instances, in many instances, when there are true needs for injured parties, the structure is going to be best suited to guarantee those. And eventually through the software and the addition of the other investment options, not that we're investment advisors, we're not, clearly, but to be able to objectively show that a structure's payout schedule and tax preferences are going to more accurately and with a lot more probability best fund certain needs into the future. And that is just to get everybody to understand that why the product was created in the first place makes it still viable today. And with everybody's ongoing support and not only just using the software, but also in feedback in daily use, will help to better the software. I know that we've already written a couple $1 million of structured settlements over the past 12 months that we would have not gotten without the software. Just the ability to say, hey, you're just automatically going to put it over here. But when you really look at the probability of that, and that's before basically what we're experiencing, which is the market collapse in the last 60 days, it was a very compelling factor in it, and it saved a couple $1 million, which we're all hoping it does the same for all of you. So I know Aaron's going to stick around, and good luck to everybody. And it was good to see everybody last week. Take care.
Thank you, Dave. Yeah, so I will stick around. I do appreciate everybody's comments in the chat and on here of their interest. Like I said, I am here to answer any questions that people have. If you have a live scenario that you would like to just run, I'm happy to run one of those scenarios. But I will stay here until 2 for anybody that wants to ask a question. And I look forward to you guys signing up. I think that this will really help the industry grow. Like I said, all you have to sell is one small case to make up for the $69 a month fee. And as Dave mentioned, we've already done that on a few of our cases. So I want to grow the industry, and I want to grow it with all of you guys. So again, I will, as I said before, be quiet and answer any questions that come my way. Okay, a couple of those. All right. Doesn't seem like there's many questions, so I will. I'm going to mute myself.
Aaron, I have a question for you.
Go ahead, Don.
And thanks. I think this is great and great idea to get people like us to help with the support of it, because I think any kind of software is very costly.
Yeah.
What about being able to maybe use like the GSS, which is tax-free? Is that something that could be incorporated somehow?
It is. It absolutely is, and we're at a limit right now. As you pointed out, software is extremely expensive, and there's a lot more features that we want to add, but we need to be able to have support to be able to add them. So outside of adding additional indexes that are established long-term indexes, our goal is to be able to factor in some of the alternative products that do exist out there, like GSS, to be able to factor those in. So there's some roundabout ways, if you will, to do it currently. But right now there's no streamlined way. So that is a goal, to be able to add all of the features everybody wants to have, because at the end of the day, that's going to only better the industry. So yes, the more support we have from everybody, the more pieces of software we can build, and the more people we can hire to do so.
How could you do it roundabout? Would you make it like 0% bonds or something, or?
Yeah, so if we went back here, what we could do, technically speaking, is if we look at GSS and we look at one of the quotes that they give out, what they're suggesting is a starting draw amount, and they're predicting the growth that could happen on a monthly income basis, if you will. If we came to our draw column, you can put multiple draws in here. It doesn't have to simply be one. You could put multiple. So what we could do is put in the starting draw amount that GSS believes is possible to start, and actually add in the COLA percentage of what they think it could grow to over time. So that's how we can, in a roundabout way, if you will, make it possible. It's the same if we wanted to add ILAPA in here, for instance. We're making an assumption of the growth that it could have on an annual basis. So if we put in an ILAPA quote here, we could put in the draw amount, and then anywhere from 0 to 5% COLA, you can make some assessments, usually 3, 4, 5%. But you can do it that way as well, and predict based off of an ILAPA of 3%, it's this percent success. But if it really did 3%, 3.5% to 4%, here's the significant difference in it. So there are some ways to do it now, but I would like it to be a little more streamlined in those goals.
Cool, thank you.
Absolutely. And thank you guys for all sticking around and being able to join us today. It's been quite a fun journey building this, and I appreciate everybody's support now. So I'll give a couple more minutes if anybody has questions. If not, please feel free to drop off, and hopefully I'll be able to see you guys at the next Monday's training session. And until then, I will send an email after this one with the login information, the promo code you guys can use, so you can really get your own hands on the software and be able to test it out yourselves. Okay, no more questions. That's great. So thank you again to all of you that were able to join. I'm going to go ahead and end it now, but I will send that follow-up email and send any additional information that comes through to you guys.